Welcome back to WealthWise, the podcast where we empower you with the clarity and strategy to navigate the complexities of your financial world. I'm your host, Sarah, and I'm genuinely thrilled you're joining us today. We're about to dive deep, and I mean really deep, into a subject that might sound a bit inside baseball at first, but trust me, its tremors could reshape your financial future in ways you might not expect. We're talking about the shifting sands of the global bond market. Are we seeing cracks that could signal a wider crisis? Now, I know what some of you might be thinking. Bonds? Isn't that a bit dry? But stick with us, because understanding this is becoming non-negotiable. And to guide us through this intricate and frankly critical landscape, we have an exceptional guest. He's a name synonymous with sharp financial analysis and astute investment strategy, having spent years navigating the high-stakes world of major funds, dissecting trends, and advising on multi-billion-dollar portfolios. He's not just about numbers. He's about understanding the human behavior and systemic forces that drive them. Please join me in giving a very warm, WealthWise welcome to the brilliant Max Wise. Max, it's fantastic to have you on the show.
Sarah, it's a real pleasure to be here. Thanks for having me.
Absolutely. And for everyone tuning in, by the end of this episode, you're going to understand, first, why those headline-grabbing warnings from the CEOs of the world's biggest banks about the bond market aren't just noise, and what they really mean for you. Second, we'll cut through the jargon to see what the hard macroeconomic data, the numbers on public debt and interest rates, are actually telling us about the ground beneath our feet. And most crucially, we'll explore actionable insights on how you can start thinking about positioning your personal finances and investments in the face of this potential volatility. So, Max, let's dive right in. For many of our listeners, the bond market can feel, well, a bit abstract, maybe even a little intimidating. It's often perceived as this super stable, almost boring corner of the financial universe, the safe money place. Yet, we've recently heard some pretty stark warnings, like Jamie Dimon, the CEO of JPMorgan Chase, talking about cracks appearing. From your vantage point, why is this topic, which seems so foundational and safe, suddenly so misunderstood and, frankly, a bit unsettling?
Sarah, that's an excellent question, and you've hit the nail on the head. The bond market, particularly government bonds, has historically been the bedrock of financial stability, the ultimate safe haven asset for generations. When things got choppy in equities or other markets, bonds were where capital fled for safety. But the reason it's becoming a source of anxiety now, and why it's perhaps misunderstood, is because the entire global economic landscape is undergoing a pretty seismic shift. We're not in the same low-interest rate, low-inflation environment that characterized much of the last few decades. The rules of the game are changing, and the bond market is often the canary in the coal mine for these larger systemic shifts. Part of the misunderstanding, I think, stems from a kind of collective cognitive dissonance. For years, discussions about public debt, deficits, or bond yields were relegated to the financial pages, seen as too complex or too macro to directly impact everyday life. There's a human tendency to tune out what we don't immediately feel, right? National debt is in the trillions? Okay, but how does that affect my mortgage or my grocery bill today? It felt distant. Then there are the common misconceptions. One is the idea that government debt is different. They can always print more money to pay it off, or a small rise in interest rates won't break the bank. While there are grains of truth in some of that, the scale we're talking about today changes the entire equation. When you're dealing with trillions in debt, accumulated over decades, even a seemingly minor uptick in interest rates can translate into colossal increases in debt servicing costs. That's money that can then not be spent on public services, infrastructure, or other productive areas of the economy. It essentially starts to crowd out everything else.
That's a really powerful point, the sheer scale of it all. Can you give us a concrete example or two of where we're seeing these pressures manifest? Perhaps a case study that brings this from the abstract into something more tangible for our listeners?
Absolutely. Let's look at Japan, for instance. A country often seen as a bellwether, or perhaps a preview, for what other developed economies might face due to its aging demographics and high debt levels. Their 30-year government bond has lost nearly half its value since 2019. Think about that for a moment. An asset class traditionally considered one of the safest on the planet, plummeting in value. And a mere 1 percentage point increase in prevailing interest rates there has already wiped out massive unrealized sums for some of their largest life insurers, who are, by definition, huge holders of these government bonds. These aren't theoretical models. This is real financial pain creating real systemic risk.
Wow, half its value? That's staggering for something considered a safe asset.
It is, and then closer to home, look at the United States. We're currently sitting on over $36 trillion in national debt. Our debt-to-GDP ratio, which is a key metric of a country's ability to pay back its debts, is hovering around 124%. To put that in perspective, economists generally consider a 3% annual deficit to GDP ratio as the upper limit for a sustainable, healthy economy. We're consistently pushing double that, even during periods when the economy isn't officially in a recession. So these aren't abstract, faraway numbers anymore. They're starting to have very tangible implications for borrowing costs across the board, for governments, for corporations, and ultimately for individuals through things like mortgage rates and credit card interest. And this is precisely why those warnings from people like Jamie Dimon, who have a bird's-eye view of the global financial plumbing, are so crucial. They're seeing the pressure building within the system. The very foundation is being tested. Understanding how we got here, what the key pressure points are, and what might happen next is exactly what we need to unpack, because the story of the bond market today is fast becoming the story of our collective economic future.
That sets the stage perfectly, Max. It's clear this isn't just a niche financial topic anymore. It's something with far-reaching implications. So let's get into those core insights. Max, you've painted a very clear picture of why this bond market situation is gaining so much attention and why it's not just abstract financial jargon anymore. It feels like we're standing at a critical juncture. So let's really unpack the mechanics here. I want to start with this idea of a debt spiral and the historic rise in interest rates we're witnessing. Can you break down for us the intricate connection between public debt, those persistent budget deficits, and this rapid surge in interest rates? More importantly, how did we get caught in what feels like an increasingly precarious cycle?
That's the multi-trillion-dollar question, Sarah, and it's central to understanding the current pressures. Let's start with how things should traditionally work in a healthy economic cycle. Typically, when the economy is strong, unemployment is low, businesses are profitable, and tax revenues are robust. In such a scenario, government deficits should shrink, or governments might even run surpluses. Conversely, during recessions, when unemployment rises and economic activity contracts, governments step in with stimulus spending and deficits naturally expand to support the economy. That's the textbook model. However, what we've observed, particularly since around 2017, and this is a point economist Lynn Alden has highlighted with compelling data, is a strange and concerning divergence. Even as unemployment rates in many developed economies, including the U.S., fell to historic lows, government deficits didn't just persist, they accelerated. It's as if governments were spending as if we were in the midst of a deep recession, even though the job market was signaling strength. Think about it. Massive fiscal stimulus, tax cuts, and increased spending continued, even when the economy was, by many metrics, already running hot.
So even in good times, the borrowing continued at a pace usually reserved for emergencies?
Precisely. And that's where the cycle begins to bite. This continuous, large-scale borrowing, even during periods of economic expansion, means governments have to issue an enormous volume of new bonds to finance their spending. Initially, when global interest rates were near zero, this was perhaps more manageable. But as the sheer volume of debt piled up, and as inflation started to become a global concern post-pandemic, investors, the people and institutions buying these bonds, started to get nervous. They began to ask, with this much debt already outstanding, and with governments showing no signs of fiscal restraint, what's the real risk that I won't get paid back in full, or that the currency I'm repaid in will be worth significantly less due to inflation? To compensate for this perceived increase in risk, investors naturally demand higher yields or higher interest rates on the bonds they purchase. And the numbers are stark. The yield on the U.S. 10-year Treasury bond, which is a global benchmark for interest rates, catapulted from less than 1% in 2020 to nearly 5% at its recent peak. That's the fastest and most aggressive jump we've seen in roughly 40 years. It's not a gentle incline, it's a steep climb. This rapid rise in interest rates then creates a pincer movement. For governments, it means the cost of servicing their existing and new debt skyrockets. For banks and other financial institutions holding vast quantities of older, lower-yielding bonds, the value of those bonds plummets, because why would anyone buy an old bond paying 1% when they can get a new one paying 4 or 5%? This can lead to significant unrealized losses on their balance sheets, as we saw with some regional bank failures in the U.S. in 2023. It's a vicious feedback loop. More debt leads to higher rates, which makes the debt more expensive, which can lead to more borrowing, and so on. That's the trap.
It really sounds like a tightrope walk with very little room for error.
It is. And the consequences ripple out. Higher government bond yields push up borrowing costs for everyone, for corporations looking to invest and expand, for individuals seeking mortgages or car loans. It acts as a brake on economic activity.
That's a very clear explanation of a complex dynamic. If I were to try and summarize that critical point, it's like
We're essentially borrowing from our future to pay for today, and rising interest rates are the bill coming due, with compound interest.
That's a sobering thought. So, Max, as this cycle intensifies and investors start to question the long-term sustainability of this debt burden, or even the stability of the entire debt-based system, how do they typically react? Are we seeing tangible signs of a shift in investment strategies, a sort of flight to safety that looks different from what we've seen in the past?
Absolutely, Sarah. Investor behavior under these conditions is fascinating and provides crucial signals. One of the most telling indicators, again, drawing on some excellent research from analysts like Lynn Alden, is the recent and unusual decoupling of gold prices from real interest rates. Historically, there's been an inverse relationship. When real interest rates, that is, interest rates adjusted for inflation, are high, investors tend to favor bonds because they offer a positive return above inflation, preserving purchasing power. Gold, which offers no yield, becomes less attractive. However, in the 2022-2023 period, we saw something quite different. Even as real interest rates rose significantly in the U.S. and other places, the price of gold also remained strong, even rising. This is anomalous. It suggests that a growing cohort of investors isn't just chasing yield anymore, they're actively seeking assets that are perceived as scarce, tangible, and outside the direct control or potential debasement of governments and central banks. They're looking for assets that can't be printed into oblivion. This points to a deeper undercurrent of doubt about the long-term sustainability of the current financial architecture, which is so heavily reliant on ever-increasing debt.
So it's not just about getting the best return, but also about protecting against systemic risks?
Exactly. It's a shift towards capital preservation in a more fundamental sense. Another key piece of the puzzle is the changing dynamics between private debt and public debt. For much of modern history, private debt, Money borrowed by businesses and individuals generally grew faster than government debt, except during major recessions or wars when governments would step in. But since the 2008 financial crisis, we've seen a structural shift. Government debt growth has consistently outpaced private debt growth, even during periods of economic expansion. It's as if governments have taken on the role of borrower of last resort permanently, not just in crises. This constant issuance of government bonds to fund deficits, even when the private sector is relatively healthy, raises a critical question. Who is going to keep buying all these new bonds, especially when debt levels are already at historic highs and the yields haven't always compensated for the perceived risks, including inflation? We're seeing central banks in some countries diversifying their foreign exchange reserves away from traditional holdings. We're seeing increased retail and institutional interest in alternative assets, including cryptocurrencies, real estate in certain markets, and other commodities. It's a quiet but palpable reevaluation of where true safety and value lie when the traditional anchors of the financial system seem less secure.
It's like the definition of a safe asset itself is being re-examined in real time.
Precisely. The playbook is being rewritten as we speak.
That's a powerful observation. This shift in investor sentiment, moving towards scarcity and tangible assets, really speaks volumes.
When faith in fiat currency and government promises begins to waver, capital instinctively seeks refuge in assets that can't be easily debased or defaulted upon.
This brings me to a concept that sounds quite alarming, Max. The idea of a debt Ponzi. It's a term some analysts have used to describe the current situation. Could you elaborate on what they mean by that? And how does this systemic issue connect to very real, tangible concerns like the future of Social Security or other public pension funds? These are things that directly impact millions of people.
It's a provocative term, Sarah, and it's meant to be. It's not suggesting that governments are intentionally running a fraudulent scheme in the classic Ponzi sense, but rather that the dynamics of the current debt system are beginning to exhibit Ponzi-like characteristics. Essentially, it implies a system that becomes increasingly reliant on issuing new debt simply to service existing debt and maintain its own operations, rather than generating enough organic growth or surpluses to manage its obligations sustainably. Let's take the U.S. Social Security Trust Fund as a very concrete example. This fund was built up over decades as baby boomers paid in during their working years. Now, that massive generation is retiring by the millions, and they are drawing down on those benefits, healthcare, pensions, etc. The problem is, that trust fund was primarily invested in U.S. Treasury bonds whose real interest rates, after accounting for inflation, were often negligible or even negative for long stretches, so the fund didn't grow as robustly in real terms as it might have. Now, as benefits need to be paid out, the government is effectively forced to sell those Treasury bonds back into the market or redeem them to get the cash. This happens at a time when the fund is depleting rapidly and is projected to hit zero within the next decade or so for certain components. When that fund runs out, the government doesn't just get to say, sorry, no more Social Security. These benefits are legally mandated entitlements that retirees depend on. So, what are the choices? 1. Raise taxes significantly, politically very difficult. 2. Cut spending dramatically elsewhere, also politically fraught. Or 3, the path of least immediate resistance, borrow even more money, issue more debt. And that's where you see the connection to this Ponzi-like dynamic. The system needs a continuous inflow of new borrowed money just to meet its existing promises. Lynn Alden, in her work, has also pointed to the sheer scale of total debt in the U.S. economy, combining government debt, corporate debt, and household debt, which now stands at something approaching $100 trillion. The actual monetary base, the physical and digital currency created by the Federal Reserve, is a fraction of that. This illustrates the immense leverage in the system. Her research shows that in the last 110 years, there have been a handful of years where the total debt in the U.S. economy actually decreased, primarily during the Great Depression and a tiny blip around the 2008 financial crisis. For the vast majority of the time, the debt mountain only grows. Any serious attempt to de-lever, to significantly reduce that overall debt load, risks triggering a deflationary collapse, as falling asset prices and contracting credit would crush economic activity. So the system becomes trapped, needing continuous debt growth to simply stay afloat. The catch-22 is that the more money that needs to be created or debt issued to keep it all going, the higher the risk of inflation and currency devaluation down the line. And when investors foresee that, what do? They demand higher yields on bonds to compensate for that risk. It all circles back, relentlessly, to the bond market, the very foundation we've been discussing.
It's a truly complex web, and it feels like the demographic pressures are only going to exacerbate these Ponzi-like tendencies, as you described with Social Security. Are we just kicking the can down a road that's getting shorter and shorter?
That's the uncomfortable truth of it. Demographics are a powerful, slow-moving, but relentless force. An aging population with fewer workers supporting a larger number of retirees puts immense structural pressure on government finances, especially for pay-as-you-go systems. This isn't a temporary blip. It's a long-term, baked-in challenge that makes the debt problem even more intractable without significant policy changes or some unforeseen productivity miracle. The can is indeed being kicked, but the end of the road, or at least a very bumpy patch, seems to be drawing nearer.
The picture you're painting is one of a system under immense strain, where the traditional levers might not be working as they once did.
Our financial system increasingly resembles a complex machine that must consume ever larger amounts of new debt just to keep running, making every economic shock or interest rate hike a dangerous turn of the screw.
Max, this has been an incredibly enlightening, if somewhat sobering, discussion about the systemic pressures on the bond market and the broader financial system. We've talked about the data, the mechanics, the potential ripple effects, but I'd love to bring this to a more personal level for a moment. With your decades of experience navigating these complex markets, living through various economic cycles, has there been a particular moment, perhaps a significant failure, a misjudgment, or a profound breakthrough in your own financial journey that fundamentally reshaped how you perceive systemic risk and, consequently, how you approach your own personal financial strategy? A real aha or uh-oh moment that stuck with you?
That's a great question, Sarah, and yes, there absolutely was. For me, the period that truly crystallized much of my thinking around these larger systemic issues was the global financial crisis of 2008 and its immediate aftermath. It wasn't a single trade that went wrong or a specific investment loss that defined it, though like many, I certainly felt the turbulence. It was more profound than that. It was a fundamental shattering of some core assumptions I, and frankly, much of the financial world, had held. Before 2008, while intellectually aware of historical crises, there was still a prevailing, almost implicit belief in the self-correcting nature of markets, in the efficacy of monetary policy tools within certain known parameters, and in the idea that too big to fail was a concept, not an imminent reality that would necessitate such unprecedented interventions. I had, perhaps naively, underestimated the sheer scale and speed with which contagion could spread through an increasingly interconnected global financial system.
So it was less about a personal trading misstep and more about a shift in your understanding of the entire playing field.
Exactly. The uh-oh moment for me was watching the dominoes fall, Lehman Brothers, AIG, the frantic, almost desperate government and central bank responses worldwide. Witnessing the sheer magnitude of the bailouts, the liquidity injections, the alphabet soup of emergency lending facilities, it was staggering, and it led to a critical realization. I had significantly underestimated the lengths to which governments and central banks would go, had to go, to prevent a complete systemic collapse. But the aha moment, Or perhaps the more sobering longer-term insight came in the years that followed. It was the understanding that this massive intervention, while perhaps necessary to avert an immediate catastrophe, wasn't a free lunch. The enormous amounts of debt taken on by governments to stabilize the system, the private sector losses that were effectively socialized onto public balance sheets, that debt didn't just vanish. It was a transfer. I realized then, with a clarity I hadn't possessed before, that this newly created public debt would have long-term consequences. It would eventually manifest as either higher taxes, reduced government spending in other areas, or, and this is key, through inflation, a de facto erosion of the purchasing power of savings and fixed incomes. It was a stark lesson in how systemic risks, even if seemingly contained at the macro level, ultimately filter down and impact individuals.
That's a powerful reflection. How did that profound shift in perspective influence your own approach to personal finance and wealth management from that point forward?
It made me far more focused on a few core principles. Firstly, genuine diversification, not just across asset classes, but across geographies and, importantly, across systemic frameworks. Secondly, a much deeper appreciation for tangible, hard assets, things that can't be easily created or debased by policy decisions. This isn't to say one abandons traditional financial assets, but the balance and the rationale shifted. Thirdly, it instilled a greater sense of humility about predicting the future with certainty and a corresponding emphasis on building resilience and robustness into any financial plan, preparing for a wider range of outcomes, including those that might have previously seemed like tail risks. And finally, it reinforced the critical importance of understanding these long-term debt cycles. They move slowly, often invisibly for years, but their cumulative impact is immense. 2008 wasn't just a market event. It was a clear signal that the underlying tectonic plates of the global financial system were shifting, and that understanding those shifts was no longer an academic exercise, but a practical necessity for anyone serious about preserving and growing wealth over the long term. It made me a much more critical observer of government promises and central bank policies, always asking, what are the second and third order consequences of this?
That's an incredibly valuable share, Max. Turning a systemic crisis into such deep personal and strategic lessons is powerful. It really underscores the importance of looking beyond the immediate headlines. So, Max, drawing on that experience and your current analysis of the global landscape, particularly the pressures we've discussed today, if you had to identify one major shift or trend in the next 3 to 5 years that you believe will significantly define financial success or, conversely, create major challenges for those unprepared, what would that be? Where do you see the puck going, so to speak?
That's a pivotal question, Sarah, because the next few years are likely to be quite formative. If I had to bet on one overarching shift, it would be the accelerated mainstreaming and maturation of decentralized financial systems and alternative stores of value. What I mean by this is a continued and likely intensified search by individuals and even institutions for financial avenues that offer greater transparency, autonomy, and resilience against the kinds of systemic pressures we've been discussing, particularly inflation, currency debasement, and the risks associated with highly centralized financial intermediaries. We've already touched upon why investors might be looking beyond traditional assets. The sheer scale of global debt, the persistent fiscal deficits in major economies, and the potential for ongoing inflationary pressures create a compelling case for alternatives. While assets like gold have traditionally filled this role, the digital age has introduced new contenders and new paradigms. I believe we'll see further development and adoption of technologies like blockchain, not just for cryptocurrencies like Bitcoin, which many already view as a form of digital gold, but for a much broader array of financial applications. Think about tokenized real-world assets, fractional ownership of real estate, art, or even private equity, made more liquid and accessible through blockchain. Imagine decentralized lending and borrowing platforms, DeFi, becoming more robust, regulated, and integrated, offering alternatives to traditional banking.
The driving force here isn't just a desire for speculative gains, it's a deeper quest for financial self-sovereignty. It's about individuals wanting more direct control over their assets, lower transaction costs, and perhaps a system that is less susceptible to the policy decisions of a few central authorities. Of course, this space comes with its own significant risks, volatility, and regulatory uncertainties that are still being worked out. It's not a panacea, but the underlying need it's trying to address, the need for trustworthy, resilient, and more democratized financial tools, is very real and growing. Those who take the time to understand these emerging ecosystems, to discern the viable long-term projects from the hype, and to prudently incorporate these alternate approaches into their broader financial strategy, may find themselves better positioned to navigate what could be a very different financial landscape in 3 to 5 years. Conversely, those who remain entirely anchored to traditional systems without understanding these shifts might find themselves increasingly exposed to risks they haven't fully appreciated.
So it's not just about new investment products, but potentially a fundamental reshaping of how we interact with and control our financial lives. That's a bold and thought-provoking outlook. The emphasis on financial self-sovereignty is particularly striking.
Indeed. It's a powerful undercurrent that I believe will only grow stronger as trust in conventional systems faces ongoing tests.
Max, this has been an absolutely phenomenal discussion. From the deep dive into the bond market's systemic pressures, the eye-opening connections to national debt and real-world consequences, to your personal reflections and that compelling future outlook. You've given us so much to think about. Your ability to distill these complex topics into understandable, actionable insights is truly a gift. Thank you so much for sharing your wisdom with the WealthWise audience today.
The pleasure was all mine, Sarah. These are important conversations to be having, and I'm glad I could contribute.
And to all of you listening, thank you for investing your time with us. We covered a lot of ground today, from the hidden risks in the bond market signaling potential systemic stress, to the critical role of understanding national debt and its impact on interest rates, and the emerging trend towards financial self-sovereignty as individuals seek more resilient ways to manage their wealth. If you found today's episode valuable, if it sparked a new thought or gave you a fresh perspective, please do us a few small favors. First, share this episode with a friend, a colleague, a family member, anyone you think would benefit from understanding these crucial financial dynamics. Spreading knowledge is a powerful act. Second, if you haven't already, please subscribe to WealthWise on your favorite podcast platform. That way, you won't miss our weekly deep dives into the strategies and insights that can help you build a stronger financial future. We've got some incredible guests and topics lined up. And finally, we'd love to hear from you. Leave us a review. Send us a comment on social media. Let us know what resonated, what questions you still have, or what topics you'd like us to explore in future episodes. Your feedback truly helps us shape the show. Remember, navigating the world of finance can feel complex, but with the right knowledge and a clear strategy, you can take control. As we close out today, I want to leave you with this thought. Financial freedom isn't just about having more. It's about having options. It's about having the clarity to make informed choices, the resilience to weather any storm, and the wisdom to build a future on your own terms. Thank you for joining us on WealthWise. We'll see you next week.